Microsoft, it had just fell down to 455. Remember, Microsoft used to be close to a $550 stock, if not even more than that. So when it comes down to these low levels, like the 440s or the 450s, we know that we can ride the wave back up to higher levels, like the 488s, for example. So this is why they fell. And it's funny because those who know how to invest, they could see it. And they had their earnings, like I told you, and they had actually beat expectations. They thought they were going to make 80 billion, but they actually made 81 billion. So imagine making an extra $1 billion. Family, that's excellent. But the stock came down still. All of the news outlets, Robinhood, they're saying the earnings revenue beat, but the stock fell. And like I had told you before, these are those opportunities in the market when a company is making more money, but the stock is falling. However, there's another one I need you to pay attention to. And what is that? It's Meta. We've been talking about Meta time and time again. So I got to give a salute to everybody who's on Instagram using it every day, scrolling and scrolling and scrolling. I got to give a shout out to everybody who's on Facebook using it every day, scrolling and scrolling and scrolling. Everybody who's using WhatsApp. I'm talking about overseas and everything. Why? Because I'm an owner of Meta. The people who have been following the page and the channel are owners of Meta, and we are benefiting greatly from people consuming social media. How are we doing it? Because we keep our ears to the ground and we see that all of these things I named, WhatsApp, Instagram, Facebook, and many more, these are how people interact with their customer base. I'm talking about all different kind of businesses in the world, whether it be a big corporation, whether it be a restaurant, whether it be a franchise, all of them, even a mom and pop type of store, even people who start businesses who you may know personally, they're using Instagram to get to the customer base. And Meta is the owner of these things. So we rode the wave from even the 100s all the way to the 700, or even some of us got in the 400s and rode it up there as well. I'm currently up because I've been buying it time and time again. 200% on this one, aka $5,000 in one account. And that's just one small account. I wanted to just put that on your radar so you can see that there's money to be made in buying stocks that people have you believe have already ran. However, I want you to think about the ones I'm talking about. Microsoft, I could see this going and being a $700 stock long term. Meta, I could see this going and being an $800 to $1,000 stock long term. Don't let people make you think that just because something is moving, that it ain't going to move anymore. They're moving for good reason. So this is one that I'm looking at called AMD. We've been following this one closely. We're making a lot of money with this one time and time again.
It's going to be Broadcom. And I'm going to give you a quick high level as far as what it is, if you don't know. So they design a lot of specialized chips. They're not an actual manufacturer, but they also help with custom AI accelerators for big hyperscalers. So they have a lot of potential, a lot of bandwidth, and very high margins. In addition to that, they had acquired VMware a couple years ago, which gives them, it's a virtualized cloud environment. So this is something that they've acquired a couple of years ago, and it's giving them some big boosts in their margins, which is great to see in a short-term acquisition. For me, their cash growth is awesome. So they're sitting at 16 billion in their cash position, and it's up 73% year over year. So clearly they're really taking it in. And then also their efficiency, they're sitting at over 67% margins right now. And that's a scenario where that VMware has bumped them up something like 13 points year over year. So that's really been accretive to their business, which I love to see. When it comes to the rule of 40, they're crushing it. Then also, as far as undervalue, this is one of the things that I really love. Their PEG ratio is at a 0.98. Something that I love to see when it's under a 1. It's never a sure thing, but it's a nice indicator in my mind. And then also, their quarterly earnings growth is up 188%. So from my perspective, I think they're a softball pitch. And then also, they had a big correction in December. Like they dipped like 21%. That doesn't necessarily mean right now is the perfect moment, but it's not a bad moment. I think that they have a long trajectory, medium, long term. I think they're great.
I'm going to get started with our second stock here. And all you out there in the nation know cybersecurity is probably, if not maybe one of the top picks or the top segments for me, top long-term growth themes. it is the one area of an IT spending budget, enterprise spending budget, that cannot be cut. I think maybe upwards of 2/3 of large enterprises got hit by ransomware attacks over the last year or two. Those attacks cost an average of $5 million each. So, companies are having to progressively spend more and more protecting their enterprises, their technologies, and cybersecurity is right there with it. Overall, cybersecurity spending is about 12% pace annual growth. But if you look at specific segments of that, cloud 18% year-over-year growth, SASE 16%. So you can find the companies that are dominating in specific segments that are growing even faster. And I think that's where Palo Alto Networks comes in, a ticker PANW. I like this one. It's not just the largest by market cap. It has the financial power to really dominate a lot of these different segments, these growth segments, right? So it's in cloud, it's in SASE, really the driving force, dominant player in some of those. Next to maybe CrowdStrike, maybe has a competitive advantage as well there, but very, very well placed in agentic as well. And really the only company, because of its size, really, that is able to participate in each of the segments within that. Just made a big acquisition this last year in in identity management. So they'll be expanding their reach into that as well. Great operating margin on this one when a lot of the other companies in cybersecurity are operating at a loss. A lot of companies, CrowdStrike, another one, Zscaler, one of the ones I hold, operating margins or operating losses because they're spending so heavily on R&D and on growth and operational costs. Palo Alto is more of a balanced approach. It's got 12% operating margin, so still profitable there, and actually the second least expensive on a price to earnings and price to earnings adjusted for growth basis. So this is one that it's maybe not the growth pick in cybersecurity. For that, I maybe go with CrowdStrike or another one, but it is definitely the growth at a reasonable price for a great sector.
From my point of view, I mean, I'm not going to argue this one much just because it's one that I really stand behind. It's one that I have in my own portfolio. As you mentioned it, so I quickly looked on my computer so I could look up what it was and like some of their financials just so that I can answer it somewhat knowledgeably, just so I'm not an idiot. Their PE ratio is crazy high, but all the items that you mentioned as far as cybersecurity is, I think it's infancy as regards to companies are going to need this more than ever. And I don't see it slowing down anytime soon because the evolution of AI, as we know, or even like this technology in general, like hardware spikes really high, software starts to kick in a little bit later, similar to how it did with cell phones. I think that like the green pastures are still coming up for companies like this, and Palo Alto, I think it's a solid choice. No concerns from my point of view.
Excellent. Great. Third stock then.
Third stock. All right. Oh boy. So my third choice is Nebius Group, which might be a little polarizing. And if you don't know who they are, it's an Amsterdam-based company. It's AI infrastructure. They provide cloud services and GPU computing infrastructure. And one of the things that I really like about them is they have a very strong cloud partnership with NVIDIA, where they're actually getting specific access to their new Vera Rubin, which they are pushing hard on that. And I feel like that is going to have a ton of potential. Their balance sheet strength, they're maintaining $2.4 billion in cash position. Let's see, their debt is super low. It's only 49 million. So their debt to cash ratio it's under 2%. So they're doing really well as far as the financials. The revenue trajectory, they're projected to be up 520% this year. So they're on a strong path for that respects. Let's see, I'm trying to look at other things. Margins are also 60% margins. They're doing really solid. Let's see, valuation gap. I really have nothing else more to add. I just see them as playing in a space that's really strong. The only concern is it's also not exactly a moat. They have so much competition that I recognize they do have risk. But overall, I feel like they're set up for hopefully long-term success.
So next stock, I'm gonna put out Walmart there, kind of a different in something other than tech. I think it's a category killer, which is what you always want to look for. Those really dominant in their spaces, category killer in retail with really so many levers to pull there. Okay, the food tariffs that are coming off. President Trump said he was going to bring down some of the food tariffs that he had implied, and I think what people don't know is, yeah, that's going to lower the cost for a retailer or distributor like Walmart, but they're not necessarily going to pull their prices down that they raised for those tariffs. So I think you're going to see profit margins go up as those tariffs come down, their input costs come down, but maybe they keep those prices a little bit higher. You know, they always say that inflation goes up on the escalator or up on the elevator and down on the escalator, so down in steps. And I think that's what we're going to see, and I think we're going to see it reflected in Walmart profit margins. They made the Vizio acquisition, so all the Vizio TVs that you see sold in Walmart, that's for a very strategic reason, because all those Vizio TVs are going to start showing Walmart ads on them. Walmart is it's just like Amazon. Its ad segment is probably its fastest growing by revenue segment there, really moving into advertising, and that GPT coming up with the ads launch there on OpenAI's GPT model, going to be working with Walmart. So I think that's a big lever there. One of the biggest ones that you really don't notice, even if you shop at Walmart like I do, some of their private brands. Okay, you next time you go to Walmart, if you do, go to look for Better Goods, the Great Value brand, their Mainstay brand, their Equate brand. These are all over. And what we've seen over the last year or two, a lot of the consumer staples companies, Johnson & Johnson, you've got Kraft Heinz, Campbell's, been really suffering because Walmart is basically moving into their goods. Okay, it's the same Amazon Basics playbook, right? Amazon let people sell stuff on their site and then kind of reverse engineered those products, put it under the Amazon Basics label, and took a lot of that market share. I think Walmart's doing that over the last year, and it's really reflected in the share price. They're going to keep on doing it. You're going to see all those Walmart brands right at eye level at the stores and taking that market share.
My next one. Okay, this is going to be hopefully another softball. I'm throwing out Amazon, and I don't often refer to Amazon in a bright light just because they are so up and down. So if you look at their patterns over time, they have a tendency to spike, and then they'll plateau for a couple of years, then they'll spike and plateau, and they keep doing this cycle. And we're kind of at that point where we've been at the plateau for a couple of years. It's about ready for that next boost. But there's signals that kind of drive that. So one of them happens to be revenue with regards to AWS. AWS is kind of in a U-turn right now. Literally, it was declining, and then suddenly it has bumped up. So it's like double digits again. So it's like 20%. It was down in the teens there for a while. So now it's starting to re-accelerate because of AI, and people are starting to figure out that, hey, they need these hyperscalers for these things. I also work with a lot of big companies, and all of them talked last year about these issues. As far as AI, they tried to do them in-house. They recognize they can't do it well. So now they're leaning back onto the big hyperscalers to leverage their tools. So I think like the big companies, especially Amazon, are going to have so much potential and growth from this that I believe they're just going to keep driving it up and up. They've also, their operating leverage, let's see. So their operating income went from 12 billion in 2022 to 69 billion in 2024. Sorry. So that was just a massive increase in a short amount of time, because in the past they tried to pay for their infrastructure strictly, from dropping their total cash flow, even though they didn't have it. Now they have the cash. So it's going to greatly improve their scenario. I don't love that they're doing layoffs, but overall, I think that they have a lot of upside because they're doing all the things, and they're aggressive when it comes to the balance sheets and free cash flow. Like, I lived it. I breathed it. Every quarterly earnings report, I hated it, but they are hardcore when it comes to their financials. I think they're good.
Okay. Yeah. Excellent. I think, Amazon's one that I missed out on for so long because, the cheap asset in me always wanted the cheaper stock, the growth, but growth at a reasonable price. And Amazon was one that, if you put it on a price to earnings basis, it never made sense because it was so expensive, because they were reinvesting all of their sales, everything back into growth, and it shows in the stock price. It shows in their growth. They grew into that. I think now, over the last few years, we've seen them kind of shift a little bit more towards profitability, and they're great. It's another category killer. They're in retail. They are the leader in e-commerce, the leader in cloud. Just like Walmart, I think advertising again is probably their fastest growing segment by revenue.
It is.
So they're doing very well, and yeah, I'm stocking up on Amazon on any dips here.
My next one, I feel like is just an easy breeze. I'm throwing it out there. NVIDIA. I think we'd be a joke not to say it. I know that so many people say it's so expensive. It's so expensive. It's at the top. The valuations are just out of this world. But the reality is they have 90% of the share in the data center GPUs for a reason, because they are the best. And I don't see them falling anytime soon. Their biggest risk is whether or not they have supply chain issues, or regulation challenges, which clearly China has now been opened up on the H200s. That is opening up a ton more sales for them. So I think they're in a really good position. I think everyone knows who they are, so I'm not going to really touch on that, but I'm just going to hit on some of the top numbers as far as, let's see. The Vera Rubin, which is the one that's coming out. This one is going to get 5 times inference performance, 3.5 training performance, and then also the token costs are going down 1/10 by using this system. I don't know what the difference in cost is between the Vera Rubin and their last iteration, but I'm guessing it's going to be a pretty expensive investment. But the payoff, I think a lot of people are just going to jump on it, because this is turning into it's an arms race when it comes to AI. And I think that everyone is investing so heavily, and I think that they're going to start asking for subsidies or some leeway as far as how they can get extra push to make sure this kind of goes even further. Let's see. One thing that I love is their AI enterprise software. They're one of the fastest growing areas for them. It's at $2 billion in annual pace right now. And it's just getting started. I feel like that's going to just be a new number that's just going to keep growing, and that's going to help their margins, because that's, I think, easy money. Plus they're scaling. I mean, their CUDA software, they're driving what everyone uses to build all of these, systems on top of their data center systems that they're offering, as top of quantum computing. They also offer the software for that. So they're touching on all these areas, plus robotics. You add all these together, they have a good 2 years of solid growth. I'm not betting against the house on this one at all.
Sure, definitely.